Good morning. Before we get started, I'd just like to share a little bit of a story about a personal experience I had in India last year. And I think it sort of really characterizes the case that we've had today. It's a story about organized chaos. And I don't know about you, but traffic in India is a little bit rushed. It's a little bit chaotic. People going all over the road. There's no lanes, pedestrians crossing. It's a bit of a nightmare. So I was very, very confronted about this situation and how to get around in India. I was very nervous about driving. So I sought the aid of a rickshaw driver who navigated through these very, very difficult traffic lanes with ease. And I suddenly felt safe. I suddenly felt trust. And I think this is what the case is all about today. It's about trust in a situation of organized chaos. And I think the bank that we're looking at today really needs to establish this, and I hope that our solution package really helps drive this home. Our agenda today, we're going to be looking at 7 key areas. Starting out, Matthew will be looking at a situation analysis, getting a feel for the macro and external environments and how that's going to impact upon the business. After that, he'll touch on the viability of project financing as an option and whether we should continue. After that, he'll hand over to Mike, who will be looking about potential re-engagement with strategic partners in some of those partnerships that have failed in the past and some of those partnerships that didn't originate. After that, he'll hand it over to Ryan and I, who will be talking about a restructuring towards the bank having more of a service-focused offering. And we really think that's key to that element of trust in organized chaos. After that, we'll cover this idea of implementation, because it's fantastic to have a great strategic idea, but without the implementation, it's really nothing. After that, we'll talk about some of the risks that are involved, and subsequent to that, we'll look at some financial modeling about our projected results after adopting this particular strategy. I'd like to hand it over to Matthew now, who will talk a little bit about the situation.
So let's take a little bit of a snapshot of what's going on here. IFCI, a pioneer of loans, long to medium-term loans, started off in 1948 after independence was granted. And what we saw was 52 years of really growing businesses within India, really allowing people to get their businesses starting up, maybe get their businesses overseas, but really allow them to navigate the financial landscape. And that's what IFCI really wanted to do by applying the ability of their expertise and allowing them to apply that expertise into developing a complex relationship with people who needed financing. And with that relationship, allow that person or that business to really grow. And what happened was, all the way up until 1991, where we saw freer markets, deregulation, and we saw all of these things happening so fast, so rapidly, and so quickly. And what happened was IFCI really lost a lot of what it could consider its competitive advantage. It lost the ability of the GSEC, its ability to leverage off the National Indian Bank to get effectively what we would call risk-free loans. And those risk-free loans is what enabled IFCI to allow medium and long-term loans to be able to be provisioned out to businesses through India and to really achieve success. And so that happened in 1991. And in 1993, IFCI decided to become incorporated. And when they decided to incorporate themselves, they lost tax-free status. They got hit again. They got lost in the mire of having to give money back to the government, having to lose money without having tax-free loans, having risk-free loans, and it really hampered a lot of their business. And what we can see, in a span of 6 years, from 1991 to 1997, this business just collapsed. The floor just fell out from underneath them, just like an elevator would if the cable snapped, and it's gone. They went from being the most pioneering, the most trusted, small to medium business sized loan business, really, and it just fell away from them. They were looking at liquidation, they were looking at mergers and acquisitions. They had 5 different sets of consultancies come and see what they could do to really achieve them to not really go and be liquidated and let all these loans that have been financed out just rot in the dust and businesses be left stranded. And that's what we saw in 6 years. And what we can see is we want to know is what happened, how it went wrong so fast. And what we can see is it's a bit of an old story. It's a bit of the Titanic. They pioneered the business. They led the way. They were innovative. They thought they were unbeatable. But really, they couldn't see the problem coming. When globalization, when the handover happened and businesses went abroad and they lost their tax-free status, they lost the ability to have risk-free loans, what happened was their business model, it collapsed. They were really naive. They were naive to think that you could borrow risk-free rates, set low tax incentives into perpetuity, to allow businesses to really enable themselves to grow into the future. And that leads us to what we're looking at today. Here's the situation. What's happening? In the top left-hand corner there, you see IFCI where it is today in 2013. On the x-axis, we have the ability to win. And right now, that is almost zero. They're only kept about by governments, large corporations who have invested interest in keeping it alive. We've got strategic firms that see that loans need to be facilitated. That's why lots of private companies have decided to make zero coupon rates for the next 10 years, enabled to keep them afloat. Market attractiveness on the top level, on the y-axis. Yeah, IFCI sits there really low because right now in 2013, we've cut 1,000 staff. We're in the advisory business. This is not where we started off in 1948, lending out money and really championing how to make businesses grow within India. It's not where we are. And what we really want to do is move IFCI from that first quadrant, 2013, into the sweet spot, where market attractiveness is high, where we can win, where our expertise is really how we decide to navigate the market and let other people use and leverage our expertise to really grow. And some political issues that we've looked at considering. Obviously, no tax-free status, no GSEC risk-free loans. The government now has identified that they don't want to bail out financial institutions. They don't want to bail out banks. They don't want to bail out anybody because they know that the money is needed elsewhere in a freer market where if everybody else is passing on risk, they can't be seen to be part of it because they're dealing with your, the local guy, everybody's money, and can't be seen to be in a risky area. In the economic scene, we've got the Southeast Asia crisis. That did lead a lot of interesting aspects to what happened with the business. But in reality, it created more risk. It created more risk for IFCI. That is something that we also need to consider. Social aspects. The really high unionized labor movement within India, something that is really important. It is very unionized. They have stratification on one level, unions on the other, and it's a really big mix that we really need to navigate in order to make sure that we overcome these issues. And strikes. Strikes are another big issue. We've just cut more than 3/4 of our staff. We're left with the bare bones. We're in an industry that we no longer have expertise in. And people are thinking maybe we should strike. Maybe we should be looking at other ways to motivate the company to make it more profitable again. And that's something that we also need to avoid. So what we're looking at is another way, another option, a solution to really reinvigorate this business and get them back on track to where they used to be. And one of those solutions is potentially to re-enter project financing. In reality, it's our heritage. It's where we started back 58 years ago. Maybe that's where we need to go back again and really decide if we need to champion that market one more time. It's our expertise. It's where we led. We were one of the first institutions to lend long-term maturity bonds, lend medium-term maturity bonds to these small to medium businesses that needed that financing. It's our brand. It's our customer awareness. Our customers look, they know us, they know IFCI, they know, hey, they lend out money. They lend out money to my coffee shop, my automotive business. If I need money, I need to go to them because they understand my business model, they understand my business in the future, and they want to see us succeed because the relationship is what matters to them. But in reality, unfortunately, it's not feasible. It can't happen. We think that this is a really bad option for IFCI to pursue into re-entering the project finance division because there's a new landscape. They took for granted what their competitive advantage was, which was risk-free loans, took advantage of their tax-free status, and their model really failed. And in reality, there's no structure anymore. We've lost management, we've lost employees, we've lost expertise, and most of all, again, we've lost our competitive advantage over our competitors. And so I'll hand you over now to Mike to look into it a bit further.
Thank you, Matt. So considering that we won't re-enter into project financing, we considered re-engaging with the strategic partners. These were the partners that we reached out to in 1997 in order to try to build a stronger business. However, at that time, none of these possibilities worked out. They weren't interested and so on. But things have changed. We have restructured, we have a new CEO, maybe we could approach them again. So let's have a look at this. In 1997, we tried to merge with PNB and IDBI, as well as seek angel investment from overseas investors. However, PNB really felt that our non-performing assets were too high, they were unfavorable, and so they rejected that idea. The merge with IDBI, they had viability concerns about our future in project financing, which, given the events leading after that, was a reasonable concern. And the angel investors, they really didn't like the terms that they were provided with. So once again, we have these three avenues. We can approach the big four banks, we can go towards the development institutions, or we can seek a foreign investor. However, if we consider what was the drive to consider the strategic partnerships back in 1997, it wasn't really due to building a better, stronger business together. At that time, the company was in crisis. It was just on the verge of collapse. It was just seeking any avenue that could stop it from liquidating. And really, what pushed the drive to look out for these strategic partners was from the government and from the employees. The Indian employees, they have a lot of power. IFCI had an employees association that really lobbied the government to really merge with another particularly Indian bank so that they would not be unemployed. So if we consider these options, they're not very strategic. They don't provide the business with a lot of future potential. They were really just a reaction because of the crisis. So if we look at the big four banks, taking the Punjab National Bank as an example, they are focused on the retail customer. And they turned down the 1997 merger because of the unfavorable non-performing assets. Now these have now been cut to zero, so perhaps they could reconsider. But what we find is that there are no synergies or benefits from merging with them currently. Because, well, we're looking at the shift into services, which doesn't reflect with their expertise at all, and it won't allow us to build into a broad banking area. If we look at the IDBI, the Industrial Bank, Development Bank of India, they are a project funding organization that was set up at a similar time. However, what we find is that their assistance to the corporate sector since 1991 is 3/4 of that of their total lifespan. So from 1964 to 2000, 3/4 is in the area after we have failed. So they have really stepped into that area where we left and they have taken it over. So having built that project financing capabilities, what really is there to gain by merging with us when we have moved on from there and we're exiting that? So there's no synergies, and it is not a future consideration. Now looking at overseas angel investors, the terms offered last time was 26% of the shares for either 3 or 5 board seats out of 8. These were offered at different prices, and because of the need to gather financing, those were offered at quite high prices, which were declined by the potential investors. So last time, Sterlite and Morgan and Newbridge Capital both took some interest, but they decided to pull out because they didn't find that what they were getting was worth the price. And then if we consider it this time, we are building, restructuring, we are restarting again. We're building the business with new capabilities. If we bring in these foreign angel investors to try and push forward their capabilities onto us, not only will it be a poor fit to the business, but the aspect that it's an American company coming onto the Indian base, the cultural differences there will just mean that they bring no advantages to us and we're just losing out on our board seats. So really, re-engaging with the strategic partners is not a viable option. And then I will now pass on to consider what is the best alternative.
Thanks, Mike. Thank you so much, Price. So where have we been? We've seen a bank that's gone through turmoil, that's gone through restructuring, close to liquidation. We see an IFCI now, in 2014, which has divested their non-performing assets. It's recapitalised and debt restructuring. It's an organisational restructuring. So what we want to stress is it's not as doom and gloom as it has been previously. We look at IFCI as a bank at square one, at a bank that's been given a new lease on life, and at a bank that has the opportunity now to move forward into a new sector. So we've outlined that going back into our historical business is not feasible. We've outlined that looking at strategic partnerships and the leverages we can gain from them is not feasible. So the third one we're looking at first. Before we move on to it, we need to understand what is the structure of the business, because we've seen these changes, but largely the structure has remained the same. Whilst we've seen a minimisation, we still see an IFCI with two focuses, on loans and advisory, which is a burgeoning business. We see an IFCI that has a venture capital branch. We see an IFCI with a financial services branch, and an IFCI with an infrastructure-based team. It's a segmented business. It's a business where they're not operating with each other, where there's no cross-collaboration, despite being granted this new lease on life. So our third proposal, and the proposal that we think perhaps is the best fit for this firm, is a restructuring IFCI into a consolidated firm. Now what we see, from turning this bank into a fragmented institution, we look at this services-based link. We look at three arms. We look at corporate client solutions, where we look at this financing arm of small to medium enterprises that we've been engaging in initially. We look at our advisory branch, again with a focus on small to medium enterprise. And we look at bringing in the infrastructure arm within this as a division of our advisory base. We look at the capital arm, which is our focus on venture capital at the seed stage, and advising business through these early areas of their life cycle. And we look at advice by bringing in this broking in terms of mutual funds and insurance. Now, as we'll go into later, we see that this is us now. We think there are growth in all of these areas. But we also see that a key thing here is then aligning this corporate center at the bottom, for reasons that I will go into now. The first one is a focus. We've seen, I apologize, that's a pretty short slide, but we've seen that post this recapitalization, we've seen that they've gone from these big project financing to a focus on small to medium enterprise. What's happened? We've seen that post this shift to SME, we've had EBIT sales grow from minus 162% to 80% in FY11. We've seen price to book go from negative 18 to 1.05%. So what does that mean? It means the market's responding positively. It means we've had this burgeoning strategy. We've tested what we believe to almost be a minimum viable product in looking at the SME space, and the market has accepted it. The market is looking positively at this element, and they're looking that maybe this is an area that we can branch in rather than slandering us for what happened before. We see that there are synergies that can be achieved through the consolidation of the corporate center and through the cross-collaboration between these branches. We have expertise in infrastructure development. We feel we need to move on that. And as to why, we need to rebrand. We need to build trust, we need to regain confidence, and it can't be in our signature product. It needs to be in this new area. In interest of time, I will now move on to Michael.
Thank you, Ryan. And I think it's important to consider strategic implementation in two key phases. We need to consider the implementation process, where we're going to be focusing on three things that Ryan just outlined: focus, synergies, and branding. And I really think those three areas are quite key to take the bank in the direction that we want it to head. But it's also important to consider the impact on these three other elements: people, culture, and formal organization. And these elements give rise to risks, which I'll go into a little bit more detail about later. I think it's important to consider a time frame when you're looking at implementation. If you're looking at implementation across a very sort of indefinite and infinite period of time, it's unlikely that your goals will actually be realized. So we've sort of set three key implementation horizons. Our first one looks at this restructuring and refocus. So as Ryan addressed, we're talking about changing IFCI into a services-focused business and really bringing that trust back, really bringing that trust in organised chaos. In the second horizon, we're going to be looking at improving and growing our advisory business in mutual loans, broking and insurance, as we think this is an area with real growth in the future. And over the third time period, this is in post up to 2020, we want to look at developing an environment for innovation within the bank. And we think this ties in really well with our adoption of venture capital. So I mentioned that these three sort of elements of our strategic selection give rise to a couple of risks. Industrial action and employee dissatisfaction. Now, in the past, the bank has had a fairly positive industrial relations history, although, as Matt mentioned, India is a highly unionized country, and it would be very naive of us to assume that this wouldn't change. So that's a consideration to take into account. The two other risks we need to consider are failure to realize synergies by bringing all these businesses together, and the brand risk that could result from bringing all of our subsidiaries under the one roof. I'll now hand it over to Ryan, who will talk about some financial projections and wrap up.
The final wrap up. We see debt to equity rising, this percentage growth 15 to 17, rising marginally over time as we do not expand on our financing. We see restructuring expenses as a percentage of sales going by 15% and 10% until they're finished in 16. And we see revenue growth to subside at 15 before growing in 15 and 16 and 17 to 4% and 7% as a result of these synergies. So to wrap up, we have a bank that's gone through turmoil. We have a bank that's been knocked down. We have a bank that has the opportunity to start again. We don't think they can go through their heritage services. We think that through restructuring and through a refocus on the services in small to medium enterprise, they can capture the rise of the middle class in India and become, once again, retained to their former glories. Thank you.
Okay, 15-minute Q&A session.
Maybe I'll start with the first question. Can you tell me something about how you're going to have a strategy to attract funding for the bank to provide the service focused financing project? How do you get cheap funding? You don't get, I mean, you no longer get funding from the government anymore. So where do you get cheap funding?
I think, so we've seen, post this recapitalisation, we've seen firms and state banks that have come in and provide us with confidence in this new business model, as long as we align it within this reduction in project financing and a focus on SME. So post liquidation is that we get zero coupon bonds. And we believe that as part of this restructure and as part of the market improvements that we've seen after this focus, we think that it won't be as difficult to raise funding from the market as it has been previously.
I might just add on to what Ryan said there. I guess our entire strategy sort of centres around bringing the bank back to an attractive credit rating. And I think that's important to secure those lower interest sources of funding that we've relied on in the past. Now, while they won't be quite risk-free as we had before with the government loans, I think getting our credit rating up to not AAA, but a bit higher would obviously bring down those interest costs.
So you're proposing to invest more in, loan to the SME, right?
Pardon?
You are proposing to get more business from the SME.
Yes.
But by definition, SME is more, credit risk is much higher. So that will impact on your credit rating. So how do you balance it?
Well, what we found is that, on the facts we had that our credit rating had improved as a result of financing the SME relative to when we had this big project financing institution. So we believe that by focusing on this services base, because the financing branch we saw isn't growing by as much, it's more the advisory-based service. So we're not as leveraged to the success of these by focusing on the services base.
So you're turning the bank into advisory consulting support, right?
No, a bank that's focused on advisory. So more the investment banking, more the advisory, more that part.
The institution has already made significant improvements in its financial position. But thinking about how it's done that, how are you leveraging on those positive changes in your future strategy?
Well, I think, as we said, the alignment towards this small to medium enterprise focus, that, as I said, so post this restructuring, they started financing these SMEs, and that's what we saw, is improvements in EBIT, is improvements in P2B, and improvements to EBITDA. So we think that by gaining on this momentum with the focus on SMEs, by also offering a service-based industry that's less risky than simply providing loans, this is how we can build upon this momentum that we've already seen coming through.
I think a lot of the positive success thus far that we've seen in recent years with the bank has been from the shift away from project financing and back into SMEs. And I think the strategy that we've sort of suggested today sort of aligns with that goal of moving away from project financing, which we saw didn't work in the past with our funding situation, and moving back towards SMEs.
I think it's a very good presentation, well thought through. Just one question, why do you consider to drop project finance completely and instead moving towards an area that you are not entirely familiar with, like SME advisory service? Are there any leverage you can leverage on your previous experience, your expertise in that area?
I'm not sure if it was explicitly outlined, but we're not actually dropping all of our project financing. Obviously, we're reshaping the focus to be on small to medium enterprise businesses. Obviously, we want to provide them with much more of a consolidated, holistic approach to helping their needs as they grow, helping their needs as they try to navigate the new financial landscape, and obviously, hopefully, become international or in some form more global. And the idea is, obviously, we want to get out of what we used to do, which was long to medium term project financing. We found that that was where our major part of risk was that we were accessing risk-free rates and appropriating them to larger companies, large institutions who are taking on more risk themselves in a longer term, which makes our burdening risk much more favourable in the shorter term, which is why we're making that shift to small to medium businesses. So our risk is less, and we also are trying to leverage what we still used to know, obviously a part of our heritage, and we don't want to let that go, but obviously catering more towards a better integrated approach to helping small to medium businesses really get on the landscape, get on the map.
And by providing a less of a focus on those big project financings, they are able to continue to develop what they have done successfully in the last couple of years by really just focusing on the low risk, high potential ones. And by focusing on just that small number that provides that, that leverage on their existing heritage, that can really boost their future potential.
I mean, why we dropped project financing at all? I don't think we ever did it well. I think that we did it well when we were a government institution and when we had risk-free rates and we had this comfort of a legislative backing. And as we saw, that timeline, we had this period of long, but we did quite well. We saw 1991, 1993, and then in 4 years, it went to shit. So it all, went belly up. So I don't think that, the bank operating in a competitive environment has ever actually had the ability to kind of compete. Yeah.
Okay, thank you.
Still, coming back to this SME, I still find it hard to reconcile the risk and return part lending to the SME. So you can see from the result that they had turning into SME and that's the result better, right? High risk, high return. That means the risk from the SME must be higher. So what do you say about the government stance looking to your change of investment strategy or lending strategy to SME and getting yourself more highly risk?
I think sort of moving into the SME and considering it as a high risk sort of option is a very valid point. But I think the facts that we were presented with suggest that our client filtering has been a lot more strict since the collapse, and that adopting SME clients doesn't necessarily mean risk. I agree that overall they are riskier clients than traditionally larger clients. But I think the filtering process that the bank seems to have adopted has somewhat mitigated that risk and has meant that SMEs are a viable solution. And as we've seen from the past few years, there's been a very positive turnaround through this sort of line of strategy, and we were just sort of seeking the natural extension from that point.
So that's risk on our balance sheet. The loans we're taking is reducing the debt that we take on as a result of financing things. And so by moving to a service base, we're taking that fee revenue rather than booking that. If we book it an SME, we've got this high risk, brings our credit rating down, and our RWA is not. So we think that by focusing more on the services space rather than financing, we can mitigate that.
Okay. So based on the risk profile sort of things, you told me that trust is very important, right? The branding. So trust is something on the safe side, but risk is on the other side. So how do you reconcile these kind of concepts?
I think the branding element related to trust in financial services. So this shift towards a more services focus for the business, I think really does relate to trust. And in financial services marketing, if your clients do not trust you, they're not going to invest their money with you or they're not going to use your services. So I think that element that Ryan talked about in terms of fee revenue from SME clients, we've got things like brokerage, insurance and mutual funds. I think they are relatively low risk for us as a business to put on. But I think, trust is a very inherent issue for clients considering a financial institution, and that needs to come across in their branding strategy.
I noticed from the chart that we were presenting quite late in the presentation that there's a significant increase in restructuring costs. Those restructuring costs, what's that going to be spent on, and what is this organisation going to actually gain from that expense?
Part of the restructuring costs are in, as we consolidate corporate centre, we think we anticipate that people will be let off as these synergies are realised. So what we factored into this broad arm of restructuring costs, the voluntary redundancy payments as we saw in the past, and obviously, we expect, as occurs with these large organisations, that they're going to be running under different systems, different operating systems. So the IT infrastructure and consolidating the financial services industry with focus on regulatory risk, we assumed, conservatively, that they would have probably different operating systems and IT infrastructure. So those costs incorporate the consolidation of IT infrastructure, the layout for both on the legal side, on the regulatory side, on the operational side, on the finance side, and really bring that corporate centre together. So that's where we're going to, we think, realise the most gains from this consolidation at the back end of the firm, but it's going to come at those significant costs.
When you say realisation of gains, do you mean an ongoing reduction of the cost base?
Yes.
Okay. And what challenges do you think that you will have in actually implementing your restructuring plans?
I think the four risks that we spoke about sort of centered around staff, branding, and the staff issue is really sort of central for us. And I think given the bank's history with quite positive employee relations and positive industrial relations, I think we can assume that the negotiations with the union will go relatively smoothly, as we saw the bank reduce their staff from over 1,000 to roughly 250, and there was very little industrial action. So I think if we adopt a voluntary redundancy program like Ryan spoke about, I think that's going to reduce the sort of the staff risk there. As for branding and bringing all of these subsidiaries under the one roof, I think that there could be some risks that are associated with the individual subsidiaries losing their identity. So venture capital, people who are interested in venture capital might not see the bank under this new centralised arrangement as a viable option. So I think clearly explaining the new structure in our marketing efforts is going to be quite key to sort of mitigate that branding risk.
In the other issues with actually the implementation, the integration of the IT systems, for example?
I think that's going to come up with any consolidation in the back end. So what that will require is strong leadership in terms of building this corporate centre, in terms of strong support from the management of those teams on each of the subsidiaries in promoting this, and having champions that show that in its its current form we aren't as successful as we could be. That by aligning our focus and that by bringing our support functions together, that we can actually make some gains from doing this.
3 minutes left. Any other questions?
Okay,
thank
so last question. Last question. So regarding the shift of focus from the project financing to the servicing of the SME, how do you think about the employee react? And how will you try to give them comfort, give them the support, and how to make them the mindset change so that they go with the change of the business focus?
I think so. That's a great question about how employers will react, because the business, as we've seen in the past, has been very employee central. And as we move more and more towards a services offering, employees and processes become very important. And if we are moving towards this change of moving away from long-term project financing towards this services focus with SMEs, and I think it's a matter, like Ryan said, of having strong leadership in place in order to make sure that employees feel comfortable in adopting this sort of forward-facing, client-facing role. Did you want to add on that, Ryan?
Yeah, well, I think we've already done the majority of it in terms of because the voluntary reduction program has come, as they said, we're going to move away from this financing and we're going to move towards an advisory base. So we've already done the hard yards in this big reduction in voluntary reduction. So this is just furthering that, engaging, and because we've seen developments, as we saw in that chart, we've seen organisational developments, we've seen developments in all this, but the structure itself remains separate. So that's the key area that we think. We've already seen this movement, and the fact that I think it was on the facts that the people who took the voluntary redundancy payment were in the key, and that we had the support functions that were happy to stay around. So we've got this area that we think we can build upon and build upon the momentum that's already been happening.
Okay, thank you.